All right, welcome everybody to this Baker Institute webinar. My name is Richard Evans. I am Advisory Board Visiting Fellow with the Center for Public Finance at the Baker Institute. And the title of this webinar is Fiscal Policy in the U.S. Economy in the Wake of COVID-19, Taxes, Spending, and Economic Growth. I mean, we're at a fascinating crossroads right now in U.S. history, and we're so excited to have the experts that we have with us today to discuss these issues regarding COVID, taxes, spending, and economic growth. Let me introduce our experts, and then I'll lay out the format and outline of the webinar, and then we'll move forward. George Barrow is a fellow in public finance with the Center for Public Finance at the Baker Institute. Joyce Beebe is also a fellow at the Center for Public Finance at the Baker Institute, and we're happy to have Maya McGinnis, president of the Center for Responsible Federal Budget in Washington, D.C. with us. The format will be, we'll have George talk for 5 minutes, and then Joyce Beebe will speak for 5 minutes, and then I will take 5 minutes, and then Maya McGinnis will present some work that the CRFB has done recently, and then we'll have a question and answer period after that. So with that, I will turn the time over to George Barrow. Actually, before I turn it over to George, for those attending this webinar, you can ask questions in the Q&A tab, and we have a moderator, Vivian Leffler, who's going to be sending those questions to us. So please feel free to be engaged. We encourage that. And with that, I'll turn it over to George Barrow. Thank you.
All right. Thank you so much, Rick. So in February of 2020, the macroeconomic conditions in the U.S. deteriorated pretty quickly. So we had willful and government-mandated social distancing measures that caused a sharp decline in economic activity. In the second quarter, U.S. GDP fell by about 33% at an annualized rate. The unemployment rate rose from 3.5% in February all the way up to 14.7% in April. Then between late February and late March, just in 1 month, each of the three major stock indices lost about 1/3 of their respective values. Then something kind of remarkable happened on March 23rd. The stock market hit a trough and started a major recovery while the U.S. economy was still in what some might say was a significant decline. By the end of April, each of the three main indices had recovered at least half of their losses. Then by the end of August, each of the indices had almost entirely recovered. And of course, if you've been watching the news in the last few days, we're now at all-time highs. Despite the fact that the stock market has done so well, the unemployment rate is still fairly high at about 7.9%, and the labor force is still well below pre-pandemic levels. So clearly the economy and the labor market are still in recovery. So the fact that the stock market recovered well in advance of the broader macroeconomic recovery led a lot of people to wonder, was there something that policy did to expedite the recovery for some individuals and not others? Did some people get left behind? So we can take a look at policy, both monetary and fiscal policy, to see what impact their decisions might have had. So with regards to monetary policy, there was a significant expansion of credit and liquidity. So the Federal Reserve's balance sheet was expanded by about $3 trillion. Of that, about $2 trillion was traditional monetary policy in the form of U.S. Treasury purchases. And then there were unconventional components or less conventional components like the purchase of mortgage-backed securities and credit to non-financial institutions. So this caused a significant reduction in market risk. We see that in the data. And of course, the conventional monetary policy caused a reduction in interest rates that traditional corporate finance theory would suggest elevated asset prices. So all this contributed to the stock market recovery. On the fiscal side, there was a $3 trillion package that consisted of aid and stimulus. The largest of those three was the CARES Act that was in excess of $2 trillion. So there were two really important components of the CARES Act. One was the Paycheck Protection Program. It was a $659 billion package to sustain small business employment. It also helped small businesses cover some of their costs. And a $560 billion component to that came in the form of direct payments to households. So of that $560 billion. Part of it came in the form of means-tested transfer payments. So if you were making below $75,000, you got a paycheck for, or a check for about $1,200, and that was phased out up to about $100,000. And then there were enhanced unemployment insurance payments. So that was the $600 weekly enhancement to regular unemployment insurance. So given that there was a stock market recovery ahead of the broader economic recovery, I took a look at some of the data, some of the high frequency monthly data to see if in fact policy might have left some households behind. And what I found was that by looking at the monthly current population survey, I found a significant upward shift in the distribution of income, particularly for low-income households. Following the onset of the pandemic, there were gains in every month between February and July, with significant gains in March, April, and May of this year. Of course, that is largely the result of the means-tested transfer payments and the unemployment insurance enhancements in the CARES Act. So the distribution stabilized in June, July, and August, and that's kind of where we stand right now. And there are a number of other studies that support that finding. With regards to the wealth distribution, we don't have data on individuals with that high level frequency, but we do see that the aggregate data showed a decline in U.S. net worth, household net worth of about 6.4% that entirely recovered in the second quarter. So to conclude, I'll say that there are likely a lot of households that are in difficult financial situations, but the targeted stimulus payments really did a lot to help out a lot of low-income households. And I would say that, again, even though some households may be in difficult financial situations, that on average, most households, particularly at the low end of the distribution, on average ended up in a better place now than they were at the onset, again, financially. And it's not over yet, but at least the first round of economic policy responses was extremely effective, in particular with regards to the distribution.
Thank you, George. Glad I could make it, but I'm here. And so next up, we have Joyce Beebe, Baker Institute Fellow, and she's going to discuss some state and local issues.
Well, thank you, John. So in relation to the state issues, perhaps not surprisingly, states have experienced shortage of revenue because of the coronavirus outbreak. So as of today, 40 states released their revenue projection, updated projection, and all of them go to the direction of, say, we will have a shortage of revenue as compared to about 1 year ago today when we make our last projection. So there's a wide range of where states fare in this revenue reduction. On the one side, you have Arkansas and Pennsylvania. They say we expect a 3% reduction of revenue. On the other hand, you have New Mexico who say, well, we expect 30% of the revenue reduction, which is pretty substantial. And in Texas, the comptroller's office said that, well, we expect about a 10% reduction of revenue. So it's somewhere in the middle. So during the recession, it will be pretty hard for states to say, well, we would like to increase personal income tax or sales tax from those traditional sources and collect some additional revenue. So instead of doing that, the states turn to a slightly different direction. So what they do is they would like to tax some new economic activities, essentially the digital economy. So that is a big topic for many, many possible things. In today's presentation, I'm going to focus on 3 areas that the states have been doing in order to get additional revenue. So the first thing is the taxation of the e-commerce, also known as the remote sales tax. This movement actually started about 2 years ago as a result of a Supreme Court ruling. So if you are a retailer, even if you do not have physical presence in a certain state, as long as you sell enough into a certain state, meaning if your sales revenue or number of transactions exceed a certain level, you are considered that you are going to collect sales tax for the sales you make into that state. So it doesn't really matter where you're located as long as you have enough economic connection with the state. You have to have the sales tax collection. So as of today, only 2 states have no taxation for the e-commerce per se. So every other state that have sales tax, they have this kind of mechanism in place. And the second avenue that's kind of related to the e-commerce taxation is if you can imagine those sellers, let's say third-party sellers from Amazon, they do not really have any sort of connection with Amazon except they are third parties. They are using Amazon as a platform or a marketplace to facilitate the sales. So the Supreme Court ruling does not really say anything specifically about those marketplace facilitators. But many states were thinking, well, in nature, you're selling the same thing. You're just not really related to Amazon as a one entity. So many states also have been putting up laws to tax those third-party sellers, which are called marketplace facilitators. So as of today, there are only 3 states that do not have those rules in place. And as recent as June and July, in order to get more revenue, Louisiana and Mississippi passed laws to start taxing those marketplace facilitators. So one interesting twist as a result of coronavirus is many of us have ordered to go food to go delivering services from Uber Eats and many places since March. So Uber Eats actually start lobbying the states or telling the states and say, well, you know what? I don't really think we are marketplace facilitators because we don't think we are. So the states, please do not classify us as marketplace facilitators. So what do the states say then? The states basically, in the most number of cases, in the vast majority of the cases, the states just say, well, we don't agree. You are a marketplace facilitator. So that's the vast majority of the cases. But there are a few states, the states are just saying, well, okay, we're not going to tax you. You are not a marketplace facilitator. But there's a third category. Whether you are a marketplace facilitator and therefore need to collect the sales taxes will depend on what your customer ordered. So if you are located in one of those 5 states that you actually order food delivery, then you are a marketplace facilitator. But if you order groceries, then you're not. So it could get pretty complicated pretty fast. But this is another movement states have been investigating in order to get additional revenue during the coronavirus. So the last area I'd like to talk about is a slightly different area about online activities. During the shelter-in-place period, many of us stay home, and many people kind of start to figuring out what is there to do. So they turn to online sports betting activities. So the area I like to focus on talking about today is the daily fantasy sports. So what are those? Basically, it's a subset for the online sports betting activities. There are 2 major players in this area. DraftKings being one of them, and they even went public in April in the middle of the pandemic. So at some point, their management came out and say, hey, we noticed during the coronavirus pandemic, we noticed a surge in traffic coming to our site. So perhaps the pandemic direct a lot of traffic to our activities, to our site, because people are looking for things to do, especially the daily fantasy sports. So, well, you know what? It turns out the management is not the only people that noticed this trend. The state government noticed that too. So many state governments start to propose rules and start trying to tax these daily fantasy sports activities. And some of our audience may ask, well, what happened in Texas? What's going on in Texas then? So a few years ago, our Attorney General issued an opinion letter, and he basically said DFS is illegal. just as simple as that. And that opinion apparently does not sit very well with DraftKings. So the company filed a lawsuit against the AG. So that lawsuit is currently pending. So if you ask today, well, what happened in Texas DFS activities, then theoretically it is illegal. So that's the update for the state's activities when they're trying to tax a few online new activities during the coronavirus pandemic.
Thank you, Joyce. Thank you so much. So just to keep us on time, I'm going to move us forward to Rick. And Rick is the advisory board fellow at the Baker Institute, and he's going to talk about several issues around economic growth and the debt.
Well, I'm totally distracted by whether I should invest my retirement in DraftKings or in the stock market, both of which seem to be doing really well right now. I wanted to talk a little bit about debt and tax policy and then growth and focus on growth. Right now, it feels like we're really at a crossroads in government fiscal policy in the United States, where back in 2008, kind of at the onset of the Great Recession, we had publicly held debt as a percent of GDP at 35%. And now in second quarter of 2020, it's above 100%. And then if we rewind a little bit back to 2017, back when the debt to GDP was only about 75%, we passed this historical tax cut, the TCJA, that really sent the debt up. And now we're in the middle of a pandemic with trillions of dollars of stimulus spending, which I think is the right thing to do right now in the short run. But in the long run, there are really going to be some trade-offs to be made. I mean, the trajectory of the debt as a percent of GDP is a very high trajectory, going up as much as to 150% in 20 years. I will leave discussion of the candidates' tax plans to Maya McGinnis, who's going to talk after me. But I did do a study of the Biden tax plan back in June, and it is interesting when you compare Biden and Trump. My gross summary of those two would be that Biden wants to raise taxes and increase spending, and Trump wants a smaller tax cut and a smaller than Biden increase in spending. The net effect of both of those two candidates in the long run is pretty similar. It's an increase in deficits and debt. But those two different approaches have very different effects on the economy in terms of who ends up paying for that increase in debt and the efficiency of those two approaches. So what I wanted to highlight is an alternative, which is growth. So some people might argue that instead of cutting spending or raising taxes, one thing you can do is just let the economy grow in a big way. And so I just did some quick calculations using GDP data. And the growth rates, average growth rates in the 1950s and 1960s, this is right after World War II, where the debt was the highest that it had been historically in the United States until now. In the 1950s and 1960s, growth rates were 4.5%. GDP was growing on average 4.5% every year. Since then, the 1970s, growth rates have been 3.4%. In the 80s, 3.2%. In the 90s, back up to 3.4%. And then in the 2000s, the first 10 years, 1.8%. And then the most recent decade from 2010 to 2020 has been 2.3%. So the point is those 4.5% growth rates that we had in the 50s and 60s that really did allow debt levels in the United States to come down from those post-war peaks, those have been really an exception rather than a rule in the last 50 years. So one exercise that I did was I took a macro model that I maintain. It's called OGUSA, and I put in some different assumptions of growth rates. So our baseline is 3%, and you might even argue that that's too high. Certainly in the short run, the economy is not going to grow at 3% in the next 2 years as we're trying to come out of this pandemic. But our long run average assumption is 3%. And debt levels at 3% are projected to be up well above 120% debt to GDP after 20 years at that baseline assumption. I was surprised. I kind of thought that what I would see is that it takes like a 5 or 6% long run growth rate to stabilize debt to GDP at 100%. But it came out to about 4.6% long run growth would stabilize current policy at a debt to GDP ratio of 100%. So 4.6%, the surprise to me is that is, although it's the upper bound, that is within the range of what we've seen since the end of World War II. But, and it says to me that it's unlikely that we'll have that kind of growth, but one option is have some kind of big productivity boom. In the late 90s, it was the tech boom, and actually the last half of the 1990s, the average growth rate was 4.5%. And so who's to say we might not have another of those? Probabilistically, it's not the most likely that we'll just go back to maximum growth, so I don't think we can count on that. But it is within the realm of possibilities. My guess would be the most likely would be something like 3.5% long run growth, and which would also require some cuts in spending and some increases in taxes, and in particular address Social Security and healthcare spending. I'll conclude with that.
Thank you, Rick. So next, we're honored to have Maya McGinnis with us. She's the president of the Committee for a Responsible Federal Budget, and she's well versed on all things about the federal budget. And so we're excited to hear from her. Maya, take it away.
Thanks. It's really nice to join all of you. Thank you. Those are really interesting remarks from all the panelists. I'll kind of kick in on the fiscal piece of it and talk about three things pretty quickly. The first is kind of how you want to think about fiscal policy in a moment like we're in and going forward. The second is what the candidates have promised to do in terms of the policies that they're talking about, the agendas they're running on. And the third is that really important point that Rick just brought up about growth. I'll weigh in on that a little bit. But clearly, so I run a bipartisan group on fiscal policy. I'm a political independent. It is not a balanced budget group, which is what a lot of people think it is, but it's an organization that thinks about how do you use debt responsibly, meaning how do you use it for economic reasons, not political reasons. And in this country, we tend to do the opposite. But what you want to do is have a very responsible fiscal policy when your economy's strong, so that at moments like this, when you're in a real crisis and a real recession, you're able to borrow to help fill in that gap. Unfortunately, what we did in the run up to this period, as Rick said, is we had a really reckless fiscal policy, both from big unpaid for tax cuts, quickly followed by 2 rounds of unpaid for spending increases. And all told, the president signed into law, Congress passed, the president signed into law about $3.9 trillion in new debt when the economy was incredibly strong. That's not what you want to do. We should have brought the debt back down. Now is a moment we shouldn't be constrained. We do need to borrow. Certainly you want that borrowing to meet the important criteria of timely and targeted, temporary, so that it actually is suited towards the moment, not with politicians dressing up their favorite policies and calling it stimulus, which is what they always do. But we do need to borrow, and we're going to need to borrow even more. I don't love that. I'm somebody who worries about the political process always borrowing excessively for political reasons, but this is when you should. But the third step of that is as soon as the economy is strong enough, and you look at GDP, you look at employment, you look at the Fed's capacity to absorb fiscal consolidation, as soon as the economy can accommodate it, we are going to have to figure out how to bring the debt back down relative to GDP. And that's right. It can be bringing spending and tax policy into alignment so the debt's growing more slowly, or it can be creating the economy to grow more quickly. Let me talk quickly about what both candidates have been proposing. And let me say that evaluating these were more challenging. We do this every 4 years, but it was more challenging than normal because they had hugely different levels of detail, where the Biden campaign had 48 plans and overall 800 different policies, each of which we looked at and scored, and is in a huge Excel file, scored. The Trump campaign, on the other hand, had 54 bullet points. So there was a lot of heroic assumptions. There's a lot of, it could be this, it could be this. But all told, what we came up with, and I think the policies are probably more important than the numbers given the level of uncertainty, President Trump's agenda really focuses on about $2 trillion, and I should say budget, everything is in 10-year numbers. But so he focuses on about $2 trillion of new infrastructure spending, another $1.7 trillion in tax cuts, $650 billion for space travel, $500 billion for other areas of defense, $400 billion for veteran spending. That's all under our average estimates. He has some savings in smaller amounts that would come from reducing drug prices, ending the wars abroad, and reducing spending on undocumented immigrants. Overall, the net effect of those policies would be to add about $5 trillion to the national debt over the next decade. The Biden administration, their proposals include $11 trillion in new spending, and tax spending and tax cuts, about half of which is offset from savings. So actually, it's a pretty similar amount that it would add to the debt, about $5.6 trillion over the next decade, but in very different policy mix, where his largest policies are $3 trillion for infrastructure and investment, almost another $3 trillion for healthcare, long-term care and elder care, almost $3 trillion for education and childcare, and then $1 trillion for expanding Social Security and supplemental security income, more for affordable housing, and money for paid leave. A lot of that would be offset by significant increases in tax policies, the largest of which is repealing a portion of the Trump tax cuts. And we have fact-checked this. The Biden campaign says it would not increase revenues for people making over $400 billion, and we find that to be very true, that their policies are targeted to do that. Couple similarities, both candidates would support large infrastructure packages, lowering drug prices, expanding tax breaks for childcare, and ending those wars in Afghanistan and the Middle East. Where they differ really is on taxes, where the Trump policy would be to lower taxes further, and the Biden plan would increase taxes, and on immigration. So those are those policies. And then let me just end by saying, I agree. The greatest thing we can do is growth. Growth is the best way that we can get out of the situation. But I also want to kind of tamper expectations, because too often what we have these days is everybody talking about the free lunch approach to everything, right? Like, oh, you can cut taxes. It will pay for itself. Oh, you can increase spending. It will pay for itself. None of those things are true. And another kind of unfortunate challenge we have is that growth rates are likely to be significantly lower going forward than they have been in the past. And the main reason for that is the demographics. We are aging as a population massively, and that is going to be very expensive for two big reasons. One, we failed to get ahead of the curve and really do what we need to do to shore up Social Security and Medicare. And two, because more and more people are leaving the labor force, so that GDP will not be growing from labor market expansion nearly as much, by about a quarter as much going forward as it has in the past. So the estimates right now are that GDP growth will be about 1.8, 1.9% on a sustained level going forward. We would love to see ways to get them higher, but I don't want to overpromise, because you're not going to be able to avoid those policy trade-offs of the basic questions of budgeting, which is if you don't want to run deficits and debt. And I think it's really dangerous to do that throughout the business cycle for so many reasons. It harms your economy, it harms your budget, it leaves you unprepared for the next crisis. It leaves you in a position like we are now, where we're not able to update our social contract and prepare for the next big challenges, whether they're from switches in our globalization approach, which I think we'll be seeing post-recession, or changes from technology. The budget constraint keeps us from doing any of those things. And so I think it's really important that we have a plan for structural balance once the economy can accommodate that. And then within there, we definitely want to think about how do you address those trade-offs of what's good growth policy, and also what meets some of your other policy needs, as issues of distribution and other things are being discussed with more and more frequency these days. So basically, there's three parts to where we are. We entered this moment recklessly in debt, over-indebted. Despite that, we should borrow, and we should borrow a lot right now. But as soon as the economy is strong enough, we should pivot and think about sound policies to bring the debt as a share of GDP back down to where it's not growing faster than the economy, and to do so in a way that meets the big challenges of the future, because we are in the midst of massive changes where our entire budget should not look like it did last century. It's going to need to be very different for this century.
Excellent. Thank you, Maya. Actually, I'm going to start with a question for you. Just when I read through y'all's comparison of the two plans, the thought that popped out, and I'd like to have you comment on it, is so if they propose two plans and one has the $4 trillion in tax increases and one cuts taxes, but they both run about the same level of deficits. Wouldn't it be true that there's more fiscal space for correction under one plan than the other? I mean, if you've raised taxes by $4 trillion, you're going to have less space to raise them in the future by another $4 trillion, I guess is my point. Whereas if you've cut them, even if that's the wrong decision, because we probably shouldn't be cutting taxes with large deficits, at least if it's a tax cut that causes the deficit, you have more space then to raise taxes in the future. Does that make sense? Would you agree with that or disagree?
Really interesting point. I think I would bring in the other side of the budget as well, though, and say because Biden is increasing spending by about 11 trillion compared to much, much lower increases under a Trump administration. In fact, in that scenario, you'd have a lot more spending reductions that you could also make because your spending as a share of GDP is going to be much larger. So if you really just think about these as two areas where your revenue as a share of GDP would be lower in a Trump world, your spending as a share of GDP would be much higher in a Biden world, you can always readjust and bring them back to the center more. And so I think a different point also might be which one would be more pro-growth. And a lot of people would argue that those tax cuts would be more pro-growth than the spending increases. But I think that's also becoming less and less true because one, the fiscal situation is bad enough that anything that adds to the deficit can be anti-growth. And two, despite low interest rates. And two, it really depends where you spend how you allocate your resources. Our budget is so consumption oriented. And the more of any new dollars that go to productive public investment, and I emphasize productive because a lot of public investment isn't, but the more that does, the more growth could come from that. So I think you have to look at the specifics and I guess the argument is both those plans make the fiscal situation significantly worse when we should be making it better. So rather than saying, well, this is a better way to make it worse, or I would like to urge all of the candidates to recognize that even though it's hard, we are going to have to put in place a plan that helps bring the debt back down relative to the economy rather than makes it worse, which both of theirs would.
Yes, I agree with that. So, George, in the aftermath of the pandemic, the stock market recovered very well, but the rest of the economy kind of lingered behind. Who were the winners and losers? What do we see in the data on that?
Yes, so that's definitely true. The stock market did recover well in advance of the broader economy. But there's one important thing to keep in mind, and that is that the stock market is not the economy. It reflects expectations over the economy, but it's not necessarily the economy at any given point in time. So we see bad economic data right now. We see, unemployment elevated. We see the labor force smaller than it was before the pandemic. That's kind of a snapshot of the way things are right now. So I would say that the stock market reflects the broader outlook, maybe into the future. And I would say that there's a lot that policy had to do with that. With regards to fiscal policy, there was the CARES Act that significantly sustained aggregate demand in the U.S. economy. And then there was the monetary expansion that reduced risk in financial markets and did a lot to expand credit. So all of these policies combined to support financial markets. But if you look at the way that fiscal policy was issued, it was issued in a way that was specifically targeting low-income households. So to that extent, there are winners and losers for sure. I would say that anybody who might have exited the stock market at a time when it was kind of falling apart would be a loser. Anybody who gained, anybody who joined during that trough might have been a big winner. But with regards to the long-term outlook, I would say that there are a lot of small businesses that are still struggling. There are a lot that are closing. there are a lot of people still losing their jobs. So with regards to winners and losers, I think that a lot of it, with regards to policy in the past, has been settled. We issued a lot of fiscal stimulus to low-income households. Anybody who holds stocks, they were obviously beneficiaries of both the fiscal and monetary policy. But I think that the losers going forward are yet to be determined, and it depends a lot on whether or not we're able to pass another round of stimulus, whether or not the money goes to the people who need it, and in particular, maybe lower income households that were disproportionately affected by this pandemic, and the small businesses that may need additional stimulus to support them through the remainder of this pandemic.
Can I jump? Excellent. Can I throw something in with George there?
Sure, absolutely.
I'm really surprised still that the stock market's doing as well as it is, given that employment has gone down so much and real GDP has dropped so much. I mean, it looks like the demand side's really falling out from under the real economy, and the stock market is nearly back to its February levels. And one explanation could be kind of what George said. You've had all this stimulus propping up the low end of the economy, but that stimulus is short-lived and it's expiring now, and we're likely to get another round of stimulus, but that at best is like a 4 to 6 month fix. And I'm surprised. So either the market must be anticipating just continuous fixes or a vaccine coming sooner than 6 months, or it's ignoring these long run fiscal imbalances. That's kind of my take on this.
I think that, and Ed Klein asked about the resiliency and the disconnect between the Wall Street and Main Street. My take on that is, stocks are valued on a forward-looking equation. We're in a world where the denominator in that equation is very, very low. At historical levels, interest rates are lower than they've ever been, so that when you discount future values less, a forward-looking stock value will be higher, whereas Main Street operates in real time. And so Main Street is feeling the effects of today. Current estimates of revenues for a very large company are really not that important today in terms of the stock value. What's really important is the next 4 to 5 quarters. And the lower the interest rates go, the longer that time frame extends. So I think that's the biggest disconnect. And then, the big elephant in the room is the Fed, who's just continually propping up equity prices, rightly so, but they are doing it, and it's important to note that. So we have lots of interesting questions. So I'm gonna just take one myself, and then a couple of you can respond. And this is from Bami Shinoy. He says, what is the impact of policy to deal with climate change on these forecasts? And so I've written some papers on that. You can raise a lot of money with a carbon tax, and that money could be used to, say, pay a dividend back to the people. So it's not really an increase in the cost of consumption goods, but it could also be used to reform the way we raise revenue. You could use the carbon tax to raise a very large amount of revenue and then pay down certain income taxes so that we shifted where we raise our taxes from, as well as expanding maybe the amount of taxes we raise. So I do think that things like carbon tax or a consumption tax, like a value-added tax, could help us solve our problem. Although they would all be extremely contentious in the political theater. So anybody else want to take a shot at that question?
I will, because I'm always a doom and gloom, like there is no free lunch, everything is about trade-offs. But a carbon tax has so many things to promise, and it actually, in my mind, is a threefer, where it can help with climate policy. It can help with revenue. You can raise a lot of money from a carbon tax. And as you said rightly, there's so many things you can do with it. You can even split it. So some of it goes to new spending, some of it goes to cut other taxes, some of it goes for a dividend. There's a big base that you're talking about there. And finally, if you do use it to reduce some other taxes, you can do it in a way that would be more pro-growth, even though normally these kinds of policies would be quite disruptive. So if you have something that's good for the environment, good for the economy, and good for the fiscal situation, take it. I mean, there are not very many policies that offer that many upsides. And I would say from the DC, there's more interest in the carbon tax on a bipartisan basis than we've seen in a long time. There's a little bit of promise there on something.
Yeah, with the carbon tax, the trick is you've got to figure out how to compensate those industries on which it falls disproportionately, right? The energy heavy industries. And the same with the consumption tax, right? There's consumption tax is something that in economic theory has been this kind of bulwark of efficiency, as long as you can provide some transfer to the people at the low end that are being taxed disproportionately. And that's where the rubber really meets the road in these policies, is there's theoretically things to lessen the blow on different parts of the distribution of firms and households, but can we really target transfers and benefits to those areas to make up for disproportionate tax incidents?
David Newberger asked, and looking forward, how important are tax policy changes to the to reduce the concentration of wealth in the economy? I have some thoughts on that, but I'm going to let y'all go first.
Can you say that one again?
So if you have how important are tax policy reforms to a reduction in income inequality or the concentration of wealth? And my take is that they play a role. It's not as big of a role as many people want to think. I think that when we look at the concentration of wealth, it's the increase in concentration of wealth. I think a lot of it is driven by concentration in the market and market power. This globalization of the world, which just increases concentration. Taxes could offset that. I don't know if they could reverse it, would be my take. And so we have these forces that are pushing us to a more concentrated wealth in the economy, at least at the upper end. I mean, really, if you look at the concentration numbers from the 80th percentile down, it's pretty much stayed the same. It's really in the top 1% or even in the top 10th of the 1% where we've seen the largest gains in wealth concentrations. George, does demographics play a role in that at all?
Yeah, absolutely. I think that as you transition towards an older population, I think that you get a lot more people that are near the peak of lifetime wealth, which is kind of around retirement. So you can actually get an increase in wealth inequality resulting from changing demographics, just because you have more people who are kind of later in their life cycle and have a higher concentration of wealth or have a higher stock of wealth. But I'll add to that one of the concerns with this recent, the Tax Cut and Jobs Act of 2017 was that it would exacerbate a growing wealth gap, that there would be a lot of problems with that. But so just 2 weeks ago, they had the release of the 2019 Survey of Consumer Finances, which will give us one of the first glances into the wealth distribution and the impact that tax reform had on the wealth distribution. So, obviously it's very fresh. The data set itself is very fresh, but at least the summary papers on it suggest that there were huge gains at the low end of the wealth distribution, that lower income households actually made significant gains over the last few years. And it'll be interesting to see the papers that come out over the next few months and the next few years that study the impact of the TCJA on the wealth distribution. So we shouldn't, necessarily jump to any conclusions just yet, but it may look as though the TCJA might not have been quite as harmful onto the wealth distribution as we might have anticipated 3 years ago.
Well,
Very,
in the
very
new
good.
data, that the concept. Oh, sorry. Please go ahead, Maya.
I was going to say, I think there's sort of 4 different policies that can get into wealth inequality. The first one is our global economic policies. Like you said, John, globalization has had big effects on this, and it will continue to. And I think we are going to rethink some aspects of globalization coming out of the pandemic, and how we do so will have an effect. The second is regulatory policies. Sorry if you're hearing an echo. Regulatory policies, but we're going to have to rethink antitrust and a lot of different issues there. So if you have global economic, regulatory, and then I'd say pre-distribution and redistribution. Pre-distribution is where the wages are going. Even if we change our income inequality, that's not going to have very big effects on wealth inequality, though obviously it will be significant, but not as big probably as the redistribution, which is what you do through taxes. People don't like the word, but that's what you do through taxes. And there you have some policies that if your focus is targeting wealth inequality, it's probably the easiest, most direct way to get at it, whether it's taxation of capital versus labor, capital gains, carried interest, those types of things, estate taxes, step-up basis at death, and then different forms of wealth taxes. So if that is your objective, tax policy is probably the most direct, but there are a number of different variables that will affect the outcome of wealth inequality.
I agree. It's direct, and I'll add to that, and I missed this earlier. I think one of the most important pieces of the puzzle is education. You can't have an equal society if you don't have an equal distribution of education. And I think we have a real problem with our education system. And for a long-term health of the economy and a long-term healthy distribution of income, we really need to improve education at the lower end of the income level.
Good point.
Maya, there was a question by Sterling Miner. He said, what happens to your calculations if growth is higher than 1.8%? I assume they get better.
They do get better. Well, Rick's numbers were terrific. He laid it out there. So you have to get, was it 4.6 that you said, Rick?
Yeah, 4.6 would stabilize you at 100% debt to GDP, but that's historically high. That's the historical maximum since World War II.
Yeah, the average in this country has been 40% of GDP. And so in order to get us back down there, you're talking about growth rates we certainly won't see. So it shows you the basic, and 4.6 is not going to happen. We wish it would, but unless there's some massive shifts in productivity that nobody sees and nobody knows how to get, that's not going to. But it's not even every point of growth. Every decimal point of growth has a significant effect on helping this and increasing well-being, because we will continue to fight based on our different perspectives about what government does, of how we should allocate resources and taxes versus spending. But fighting over a bigger pie is better than fighting over a smaller pie. And about 4 years ago, this was a big conversation because President Trump talked a lot about increasing growth, and he had a whole lot of different numbers out there, all of them huge. And I think he almost set the bar way too high for what meaningful growth would be. But Rick, you said if we could get to 3.5% sustained growth, I'd be thrilled if we could get in the upper twos. That would make a real difference. So yes, pro-growth policy on tax, on public investment, and where the areas where the highest returns are going to be best will really pay off. But I do not want to buy into the kind of free lunch. So all we should do is worry about growth. We have got a real problem of our taxes and our spending not aligning in this country. And we need to change the way we budget so that we ensure that if we're doing something that we want, that there's new spending we want to do, we figure out a way to pay for it, either through higher taxes or lower other spending.
I agree completely on your view that we should not solely focus on growth. But I guess I would nuance it a little and say, I would like to focus policy by policy on growth. So if you tell me we need to raise $100 billion in revenue, I would want to say, which way could we raise $100 billion and hurt growth the least? Or if we're going to spend $100 billion, what if we spent that $100 billion on would raise growth the most? So instead of just saying, if we had more growth, if we had magic beans, we could grow a beanstalk. We need to focus on which policies create or foster the greatest environment for growth? And I think that's basically what you were saying, but I wanted to state it specifically.
It is. It is. Let me throw in one other. What did you say? Nuancing. You used nuance perfectly. Like, I want to nuance it one more also, which is, I agree. Pick your objective and find the best pro-growth way to get there. But also, I do think, especially given where we are right now, letting the distributional impact play a role in your consideration matters, because a lot of the most pro-growth policies really do benefit people who are already doing better. And if that's not your objective, you have to balance those two.
I agree. Distribution and growth, or efficiency and equity, are always trade-offs, and we always consider them together. Joyce, we had a question about which two states don't tax e-commerce. I'm actually curious to know that as well.
The two states that don't tax e-commerce is Florida and Missouri.
Okay, very good. And I have another question for you. So in Texas, Governor Abbott asked agencies earlier this year to cut their budgets by 5%. The budget board in Texas, or the controller, has now said that there's probably going to be needed, or we're going to need to have an additional 4.6 billion cut in order to balance the budget. What do you think the plan will be to do that?
So a lot of people have their eyes on Texas has a huge economic stabilization fund, or ESF. People call that rainy day funds in short. So the controller actually said, well, you know what, as of next August, we will have about $8.8 billion left in that fund. So it's one of the biggest funds in the country that with a balance. So a lot of people has been saying, well, that's a rainy day fund, and this is a pretty rainy day we have. So the discussion has been, well, now we have the fund, how much should we spend, or essentially how much should we left in the pot of gold? And after this whole thing is said and done, and what are we going to spend it on? And the obvious choices so far people has been proposing are to, finance the budget, and second, to sort of reopen the public school safely, and also perhaps supporting the public health and maybe the PPE purchase, those kind of things. But on the other hand, some people are also worrying about, well, you know what? The way we finance the rainy day fund is through oil and gas production. And everybody probably know what happened to the oil and gas production recently. So their point is that the fund will not be replenished as fast as in prior years. So if you completely empty everything, then we're going to have no reserve fund going forward. So come next spring, the biggest task for our lawmakers will be to decide on what to spend and how much to spend.
Okay.
Can I add something here, Joyce?
Yes.
Absolutely.
I mean, Texas is in an amazingly healthy place that they even have a rainy day fund, and also that debt is small relative to state GDP. I mean, there are other states like Illinois, like Connecticut, like, just focus on those two that have really high debt as a percent of GDP. And then you have people moving out of the state. And these issues of how do you raise revenue in a state where you're losing your tax base? I mean, these things like internet taxation and anywhere where they can get revenue are just going to be so important for this large number of states that are in way worse of a position than Texas is.
So you're exactly right. Over the last couple of years, the issue when it comes out to be about rainy day fund discussion, everybody was saying this is way too big. We need to find a way to spend it down. And they did. They spent another $6 billion just in 2019, mostly to finance the Hurricane Harvey and relief, and then also other teachers' pension and other things. So after they make the biggest withdrawal from the fund's history, then now they're saying, well, you know what? We are facing a different issue. Now we may think we don't have enough. But Rick, you're exactly right. Texas is very fortunate. It has all those natural resources. So it gave us a big rainy day fund. And like you said, Chicago in particular is very aggressive about taxing the online activities. And so maybe that will be one way for Chicago to continue going that direction. But there has been a few cases where Illinois, Chicago, or other counties in Illinois, they tried and they didn't make it to pass the digital taxes.
And then I think Texas is the primary destination of people moving from California, from a relatively high tax jurisdiction, and right now high wildfire jurisdiction, into Texas. I mean, Texas is benefiting from people moving for tax reasons.
Right. That there's that. Right.
Okay. Very good. So I wanted to throw out another question from some viewers. Sterling Minor again asked, low income did well through August, but not since. So anybody have a take on that? I mean, I guess I would have expected they have done all right through August with the unemployment rebates that were offered, unemployment compensation, and certainly since then it would be getting worse to the extent those are reduced. Now, I guess the extra unemployment insurance has certainly expired for most people.
Yeah, John. So there was a significant upward shift in the income distribution, particularly at low income levels. That's what the data shows. So I looked at every month after January. So we actually saw a very small gain in February, which was, to me, a little bit surprising because most of the stimulus didn't come until March. And so I think that part of that might have been just a natural kind of continuation of an economic expansion. But we saw obviously huge gains in March, April, and May as these means tested transfer payments went out, as we had this unemployment insurance enhancement. So as we progressed throughout the summer into the later summer months, we saw a stabilization of the income distribution. Now, it's important to note that this measures annual household income. So to that extent, people had an improvement in their annual income, not necessarily the monthly income distribution, but the annual income distribution. And that stabilized towards the end of the summer. So some of the most recent data that we have is for the month of August. And in the month of August, we saw a slight reversion back down towards, basically a loss in the higher end of the distribution towards the lower end of the distribution. So yes, it did stabilize, and I don't know that there's any reason to think that there's going to be any bit of an improvement without some kind of another stimulus package.
With that, we're coming to the end of our webinar. So I wanted to just take this last couple of minutes to thank the Baker Institute crowd, Rick, George, and Joyce. Thank you all for all your hard work and putting this in. And I want to give a special thanks to Maya McGinnis. I just really enjoy every time I hear you speak, and we're looking forward to hosting you at the Baker Institute as soon as we're allowed to travel and gather and do all the things that we love to do.
Yeah, well, thank you all, because I'm a huge
I'm
fan of the Baker. I can't wait to be there in person. So I'll say that.
Excellent. We can't wait to host you in person. I want to thank all of our viewers. We appreciate y'all coming and listening, and we appreciate your questions. I hope everybody has a wonderful day. The weather here in Houston is absolutely perfect today. And so thank you all, and everybody have a wonderful day.